Everyone can benefit from good financial advice, and sooner or later, almost all of us will need to pay for it. But advisor charging is a minefield, and it's very important that you understand how much you're going to be paying and what services you're paying for. Our guest on this episode is an expert in this area. David Owen has worked in the financial advice and asset management sectors since 1992, including at a senior level with HSBC. He now works as a consultant to client-centric financial businesses and to the New Talent Alliance, which aims to attract high-caliber individuals to the financial advice profession. David Owen will be telling us why having a good financial advisor can be truly life-changing.
What it always comes down to is peace of mind. People want to know that there's somebody there in their corner that they can rely on to make sure they don't make all the tripping points in life.
He'll explain why, although most firms charge a percentage of assets under management, he believes fixed fees are the future.
What I like about a fixed fee is you agree the work that's going to be done over the year, you agree how much it's going to cost. You pay that despite markets are up, markets are down, you add more money, you take money out, whatever. And then the following year is another discussion, because it's, okay, so we've done this, we've got to here, which is great. So over the next year, what needs to be done? And let's reset a fixed fee. And I really like that model because it's totally clear.
And he'll tell us the questions you need to ask when choosing a financial advisor.
Great advisors have great personalities. It's a personality game. Everything we engage with in this capitalist economy that we live in is done on know, like and trust. That's how we operate. So that's important. That's important you do that with the advisor. But don't let that blind you to the charges.
Here then is my interview with David Owen. So David, before we start, we need to make it clear to people that you and I both believe that good financial advice is well worth paying for, isn't it?
Yeah, absolutely. It's fascinating, really, that multiple studies have been done trying to see what people quantify as value from financial advice, because that's, I think this whole podcast out there, interestingly enough, trying to, on the value perspective, and what is value, Robin. And what it always comes down to is peace of mind. People want to know that there's somebody there in their corner that they can rely on to make sure they don't make all the tripping points in life, and they're accessing all the best things and tools and switches and levers and everything else you can do financially to get the best outcome, and they carry on living the life.
I would say that young people, in their 20s and 30s, when they're starting out, they don't necessarily need to take financial advice. I mean, it might be in their interest to do so, but generally they don't need to. As you get older, it becomes more and more important, and particularly as you approach retirement.
Yeah, but it's fascinating though, because I would challenge in there. It's all about financial literacy, Robin. And unfortunately, we're not, we were just talking before we talked about this, about the latest Robbie Williams film and how he's portrayed as an ape. We are funny apes. We are totally funny apes. So, to use the Steve Peters analogy, we've got an ape brain, we've got a computer brain, and we've got this human brain. But the ape brain obviously reacts far quicker, system one thinking, if you use the Daniel Kahneman. We're not very good at stepping back and thinking about things. So I think it's even more difficult now as well for younger people. My son's 22, they're bombarded by notifications. They're, the TikTok shops off in them an offer on something. And me, myself, as an older person, going to AliExpress to buy something for a hobby, and you're offered all sorts of things. So for younger people who are digital natives, I think the noise around their life to do all the right things financially is even more difficult than our generation. I'm a boomer. I think you're far younger. So I'm a boomer, and we had a space in life where we could think clearly up to a point and make far more rational decisions because we had people around us at work giving us tips and stuff like that. Now it's really difficult. So I think for young people to be able to save and also to navigate house pricing, cost of living, subscriptions, I think it's difficult. So I think that there's space to educate people in a financial literacy way, not to probably charge them in the way in which, because they don't need it. the same way. How would you create a charging model that probably is sustainable? Hopefully somebody out there's got the answer. But they need to be given tips to be able to navigate this world and be able to save money. So they get in a position at some point in their life where they've accumulated wealth, then say, crikey, I've got so much now, I could really make some bad choices and I need somebody to engage with. And I think that's what we need to get there. I think that's a big, important part we need to solve.
I think there is a small proportion of people out there who have the time, the inclination, and are willing to develop the expertise to manage their own finances without a financial advisor. But it is a risk, isn't it? That's the bottom line. And yeah, I mean, we engage our chimp brain too often as investors, and that's an obvious way in which DIY financial advice, if I could call it that, is a risk.
Yeah, absolutely. You can see it around tax-free cash. First of all, I've just used the wrong phrase. So you've got a pension commencement lump sum, this obviously in the UK, which you get, for example, if you work for you work for a large employer and you've got one of those gold-plated schemes, you can get 1.5 times your final salary tax-free cash, or 25% of an accumulated fund if you've done a direct contribution. And what people then do is they go, right, I've got some tax-free cash, or call it tax-free cash. I'll buy things with it straight away. So people retire and they use this tax-free element to buy a new fridge, a new washing machine, fix the roof, holiday of a lifetime, brand new car. And they go through all these different things. And then, 7 years down the line when these things start going wrong, they've got a load of expense. But also they've just, basically killed a load of tax-free stream of income. And I think, or you get them, they go out and buy a Porsche 911, or something. It might give them a lot of joy, it might make a lot of sense, but it's really great to say, look, we're thinking about doing this. Can I just bounce it off you? And they say, right, okay, let's plug it into the financial modeling software and let's work out what's the best option. Let's run multiple scenarios, multiple what ifs, and work out what's right for you. If we just take a bit of a step back and we look back at this as if you were 99 sitting in your chair, looking back in your life, and then play this through. And I think that's what people get the value from.
So good advice is worth paying for.
Absolutely.
We all want value for money, whatever product or service it is we buy, a house, a holiday, a maintenance contract or whatever. There is a very wide range of fee structures, isn't there? And the most common one still is the one that historically has been dominant, and that's charging the client a percentage of the assets managed.
Yeah, and it's a fascinating model because it's really worked for people. I mean, here in the UK, what happened was, I think it's worth taking a step back in time. 2013, when advisors in the UK started to have to charge overt fees. Before that was commission. So for example, you might have got paid by a provider 6% for investing. So £100,000, you got paid 6% of the £100,000, £6,000 you got paid by the provider. But the client only saw that as a disclosure amount on a piece of paper. They weren't physically writing a check or anything like that. So then from what we call RDR, the Retail Distribution Review. So if we take from 2013 onwards, when advisors had to charge overt charges, their terms of business letters would state, and this is sort of stabilised now, usually it's 3% up front for the initial advice, and that's all the financial planning, working out what's the right thing for the client, writing the financial plan, things like that. So if somebody's got, let's say, £100,000, 3% of that, £3,000 will pay for the advice. Now, really fascinating about this, Robin, is I speak quite often to industry professionals who are not in the advice business, but they're in the manufacturing side, who think that they write a check. Of course they don't, because we have this amazing thing called investment platforms who facilitate the charge. So the client doesn't write a check nowadays, do they? But they bank transfer £100,000 to the platform, and the advisor then implements that by investing it on behalf of the client. And then the platform sends the £3,000 to the advisor, the 3%. So they facilitate that, and they do it that way. And the way in which they do that, because it's done through implementation and it's VAT free rather than writing a check, it all works out very, very efficient for everybody. Now, as a result of that, That's that 3% up front. But the advisors then switched on to something which is clients clearly benefit from, which is paying an ongoing advice fee. Because this is this point we were talking about earlier, is it's knowing that there's somebody in the corner. So let's say an advice firm, a decent advice firm, can probably handle 100 relationships, 100 families, and look after them really well, particularly as they get older, because as we know, things get more complex. So what they will do is they charge 1% of the total funds the client has invested on an ongoing basis. Some charge 0.5%, some charge 0.75. It's always read your paperwork and obviously question this. And then that's it. Going forward, that's what they charge. And that's just generally the model how it works nowadays.
Now, these sound like small percentages. They are small percentages, but because of compounding, they really can add up over time. So the difference between 0.75 and 1% might not seem like a great deal, but over time it can be.
Oh yeah, absolutely. Because if I was explaining it to somebody, I would say something like, what we do is we invest your money initially, and it only costs a certain amount of money to do that work for you. So we won't charge you more than X percentage, capped at, for argument's sake, £6,000, because it doesn't cost more than that. There's 3 elements to my advice, which is the time, the expertise, and also the insurance risk, and that's where it all goes to pay for. Then going forward, we charge an advice fee. Let's say we charge 1% a year, which means 99% of the money that's made is yours. And that sounds great, doesn't it? But like you say, that 1% of, if someone's got a million, 1% of a million, £10,000, like you say, over time, as the money grows, compounds. Obviously, the advisor takes it the other end as well, because if markets go down, the advisor gets less. And where it doesn't make any sense whatsoever is where a client then goes in to use the phrase we call decumulation, which means you start drawing down on, let's say, your pension because you're taking a step back in life. I don't like using the word retirement. So let's say you take a step back in life, you start drawing down on this wealth you've accumulated. If somebody's taking, let's say, 1% on a decumulating amount, from a business point of view, from the advisor's point of view, you can say that doesn't make sense. From the client's point of view, it's like, all of a sudden it starts making sense. So that's something that's got to be solved as more and more people retire, I think.
I like to say there's nothing wrong or right about particular advice models, charger models. A charger model is either fair, good value, or it's not. As you say, there are some people, for example, in drawdown who might benefit from that assets under management percentage fee ad valorem approach. Also, people with smaller retirement pots, people maybe in their 30s, for example, might benefit from paying ad valorem fees.
Yeah, I mean, but what do the advisor take them on that? And this is the thing, because from an advice firm, like I said before, you've got time, you've got expertise, and also you've got your insurance risk. Now, if you've taken on a client who's got a small amount of money and you're charging them, for example, 1%, and they've got 30,000 in the pension pot, it isn't going to cut it. So you're starting to find that most advisors here in the UK tend only to engage with people who've got, let's say, over 200,000, because anything less than that, it isn't economically viable. I think there are some small firms, on the fringe at the moment, and the fringe, that's not a bad fringe, it's a good fringe, because it's all good, is that what they're doing is they're charging a subscription model. And I think that's really interesting. And I did hear somebody in America who comes from one of the Native American tribes. They'll say the people who really are the Americans, controversial at this moment. So I think what they said is when they meet with the chief, always says, still to this day, they will say, they have a powwow, apparently, and they will say, right, the decision we make today not only affects us, but affects the generations that come after. So can we make this decision with those people in mind? So this person's come up with a brilliant idea, is what we should do is we should advise the family tree rather than the individual, because it's the family tree that's been impacted. So I can see there are some people now are moving to, rather than just ad valorem for one person or a couple, what they're saying is, okay, let's come up with a charging model that works for the family. So therefore, and that might be you pay a fee, but your children still get access to financial advice. And I think, so I think that's going to emerge now. There's people probably need and demand that.
A more established charging model, but still nowhere near as common as ad valorem charging, is the fixed fee model. So instead of charging a percentage of your assets as the initial fee, the advisor will charge you a fixed fee depending on the amount of work entailed. And then going forward on a year-by-year basis, they will then charge a fixed fee, which may of course go up with inflation or whatever. So tell me about that option. That's particularly attractive, isn't it, for those with larger portfolios?
Yeah, myself, I pay a fixed fee to my advisor, and I see the benefit. Even though I'm an advised professional, I see a benefit in having somebody who can talk sense into me, because let's say I'm an irrational ape. So I think fixed fee makes sense to me. What I like about a fixed fee is you agree the work that's going to be done over the year, you agree how much it's going to cost. You pay that despite markets are up, markets are down, you add more money, you take money out, whatever. And then the following year is another discussion, because it's, okay, so we've done this, we've got to here, which is great. So over the next year, what needs to be done? And let's reset a fixed fee. And I really like that model because it's totally clear. Gets more complicated tax-wise. If you're implementing advice, then that's fine, there's no VAT. So generally, fixed fee works. It's still taken from the platform. The client's not writing a check. But imagine some people have moved to a model which is, what we'll do is I will give you financial planning advice, Robin, but when it comes to the implementation of the advice, where you decide in the right platform and the right funds to go in, I can give you general guidance. But what I'll do is I'll charge you for the financial plan only. Now, because there's no implementation, the client then is writing it or bank transferring. That then, arguably, is VATable. And that's a thing to think about as well for people, because what they're doing is they're paying that money out of their taxed income, and then they're paying VAT on it. If it's implemented through the platform, and they've got, let's say, a very wealthy person, £2 million, and they're paying, let's say, a £5,000 fee out of that, the platform's implementing it, and it's not come out of their taxed income, and it's not paying VAT. So there's a nuance there I think clients particularly need just to be careful of.
So what you're saying is, if you want to pay for the financial plan only, or you just want to pay for by the hour financial advice, there are a few financial advisors, not very many, who do offer that. The downside is that you have to pay an extra 20%.
Absolutely.
Which you're probably not going to be able to get back. Is there a case still for doing that and actually managing your own money yourself, if you like?
I think there's real value in a financial plan. I think a financial plan, more than anything, is huge value. So we talk about cash flow modelling tools, which is that's an interesting one. Because you talk to a financial advisor about what cash flow modelling tools, and an accountant, it's two different languages. But let's say it's projecting forward the art of the possible, projecting forward somebody's life, like I talked about earlier. You talk to somebody and say, you're 99, talking to your great-grandchild, looking back on your life, what's that story you want to be able to tell them? Let's model that out. Using the capital you've got, let's work out how, using the capital you've got, and the tax reliefs you've got, and all those different things, how you could create that story. Let's model it. And then the nuances come, topically where we are today with, inflation mentioned in the UK, the new inflation rate. It's talking to the clients about what's your own personal rate of inflation. Never mind what the BBC are telling us it is today, what's your own personal, let's work that out. And then working at your portfolio. And it's important to understand the portfolio a client's using, because there's different capital market assumptions you can make based on the blend of the assets. Obviously, there's loads of research behind this. So what you could do, for example, one type of portfolio might have a projected growth rate, gross of tax and charges, of 8%. Another might have a projected growth rate of 4% based on the mix of assets because of that, reversion to the mean. Go off and Google it if you want to know what that is, viewers, listeners. But because of reversion to the mean, it has that impact. Because you can model it out, it's great. So what it really means then, this is where it gets tricky. As an advisor, it's really good to have a handle on the assets. Because if you have a handle on the assets, you're advising on the assets, the implementation, you know what platform, investment platform it's on, custodian, you know what funds it's invested into, you're getting briefings from the fund managers and things like that. You know what numbers to plug in. If the client's doing their own thing, that's the danger. Now, obviously, you can hold the feet to the fire by challenging them about the things they're doing, but the client then has to realise if things go wrong, they're not insured for those actions. You know, paying the advisor to advise them on them, then they're insured. But the client then takes the risk that if we saw it with, don't even have to mention names. There's several examples of really well-regulated firms, as in investment firms.
Equitable R.
Yeah, that'd be a good one. That record that goes on. And then it goes, well, I was pensioned with Tesco's was with Equitable Life. And then it goes wrong. Well, if you've got an advisor in your corner who's insured the advice, you're okay. If you haven't, and you've done that yourself, you've thought they're a good thing to bet on, then it's your responsibility.
David, you've worked in this profession, this sector for a long time. You've seen a number of different fee models evolve. Up until RDR, obviously commissions were the main way in which advisors were paid. Since then, the assets under management percentage fee model has dominated. Increasingly, we're seeing firms move to fixed fees. You mentioned subscriptions, and we discussed pay by the hour as well. Where do you see the future? Which model do you think will be the kind of default model, say in 10, 20 years' time?
I think fixed fee. It depends what the advisor calls it, Robin, whether they call it a subscription or they call it fixed fee. I think fixed fee will be the one. And I think the regulator is going, even though the FCA here in the UK is not a price regulator, I think the questions they will ask around consumer duty, because about price and value, and I've got to remember, with your background, the evidence-based investor, one of the most often used words in the consumer duty paper is evidence. So from the client's point of view, is what is the evidence that the client is getting price and value and the optimum return from the advice that they give and the investments they choose and things like that, and the fees they pay. Now, it's difficult to measure, but if the client says, I feel that I'm getting value for money, as in, I feel that despite the price I'm paying, I'm making both the psychological, lifestyle, and also I'm getting more than I'm paying in fees back from this advisor, then that's great. I think being able to measure it on a fixed fee and resetting it each year, I think is probably the general direction, particularly as more people retire and they need more stuff doing, which isn't just about investing money. It's about the advisor doing a shift that's appropriate for that client and being able to afford to give the advice. Because at some point, if you charge ad valorem on a percentage basis, at some point that client doesn't become economical to service. So what happens then? Fixed fee, yes you can. Ad valorem, there's got to be questions that are going to be asked.
So we've discussed advice fees. Let's move on to investment management fees. And this is a very complex and sometimes opaque area, isn't it? You can, as we discussed, manage your investments on your own. As you mentioned, there is a risk to that if things go wrong. Let's talk about people who want their advisor to manage their money for them. What are the different options available?
So what you've got is, so the advice, if you think about the advice sort of industry, if we call it that for now, I know some people say, oh, David, that's a profession. Yes, it is, but it's also an industry. So what we have to remember, first of all, the regulator, FCA here, categorises people in three categories. It doesn't matter what you do, you're either a manufacturer, a distributor, or you're an advisor. And then the consumer duty regulation, which is a beautiful piece of written regulation, looks at what your requirements are to do what you do. Now, let's say your advisor creates their own portfolios, which I would say is probably a minority nowadays. They are still manufacturers. So they must still meet the same demanding requirements that the big asset managers of this country and this world have to comply. Research, pricing, everything at all, everything they're supposed to do. It's a big burden when you think about it. Because what we've got to remember is the majority of the advisors in this UK, there's a disingenuous term that's used by business development managers, the asset managers, but the Freds and Cheds. So it's a person, usually male, who operates a small business with a couple of administrators looking after the financial affairs of their clients and doing a damn good job. That's what they do. Now, what they might do though, is they say, right, well, I've got a lot of compliance stuff to do here I can't do on my own, and a lot of fund choice and tax wrappers and all those sorts of things. And I really just want to give people great financial advice. That's my skill set, as in manufacturer, distributor, advisor. I'm an advisor, that's what I do. So what they then do is they either through an advice network, and people can find this out quite easily by the paperwork they get from an advisor. If they look at the bottom, it might say, Fred and Shed Limited is an appointed representative of. Now, if they're an appointed representative of, that means what they've done is they've contracted out, a bit like your vets does, like we all had a local vets once upon a time, and then all of a sudden the equipment started costing a fortune, and now we have these referral centres. So your vet has a stethoscope and the referral centre has all the magic stuff. So they're part of a network that contributes to all this. So with an advice firm, what they do is they become part of a network, appointed representative of, and that network is given a well-known name, and then what happens is it looks after their compliance, their insurance, their suitability, make sure their advice is absolutely spot on, and also does the due diligence. Now, I carried out a role for a large network at one time where we were spending $1.5 million a year just doing due diligence on behalf of clients. And so what they will do is that they will then put portfolios together. Now, here's the magic act, because what you do is, what does the network get out of it? Well, the network charges the advisor a proportion of their fees for those services. So let's pick a figure. Let's say it's 20%. So 20% of the client's fees go back to the network. Now, the problem is, to run an advice network, it's blinking expensive. It's really expensive. Because just like everything in life, we all suffer from things go up, or we pay the same for them and they're smaller. It's one way or the other. So what happens is with a network is they run their own portfolios. Quite often they're an asset manager themselves, a well-known name, or they build portfolios themselves, but they build a margin into those portfolios. And that margin then pays for the running of the network to provide the advisor all the services they want. So where the client looks on a piece of paper, and we talked about earlier, ad valorem fees, fixed fees, or subscription, that's all set out in your terms of business. It's all set there, and then when you finally do, the business is implemented, you'll get another piece of business, another piece of paper that sets it all out very clearly in pounds, shillings, and pence. We should have got that before. What also isn't disclosed is the cost of running the funds, because that's where the margin is. Now, what you could go is, I'm not having that. I'm not having that, because what I'm going to do is my £1 million, I could replicate it myself, exactly what they're doing, and I could do it for less. Yes, you could. Yes, you could. And there's nothing stopping people doing that. But quite often what these networks do is they will have on their, what they call panel, and it's very difficult to bias these things, so the regulator won't do it, but prominently they will market their own portfolios, but they will also have other well-known names in there. They've had due diligence carried on, that the advisors can choose. Now, those are normal asset managers who've built their own margin, but usually cost less. And that's the key thing.
I did warn at the outset that question that it is a complex area, and you've just confirmed that. Just to clarify for people listening and watching, you pay your advice fees and then you pay for investment management on top of that.
Correct.
And as you say, it can be quite hard to work out how much you're paying and who you're paying it to. You and I strongly believe in the value of independent financial advice. You are talking here not just about advisor networks, but networks who are also asset managers and have their own funds, which they presumably want their clients to buy. There are tensions here, aren't there, as far as the independence of these firms is concerned?
Yeah, it's so as a network, what you do is you have to convince the advisors that what you're offering is the best. It's designed for the clients. You have research done on the end client base, what they're looking for, and all this sort of stuff. But we've got to remember when we strip away the marketing, when we strip away all that, funds are pretty fundamentally simple things, really. So you've got a strategic asset allocation, which costs money to research, and that's, for example, do you have 60% equities and 40% bonds? And then within that 60% equities, how is that broken up? Within that 40% bonds, how is that broken up? And then what funds do you invest in? And then how do you rebalance that on a regular basis? Do you rebalance it on a regular basis? What impact do the trading costs of rebalancing it regularly have? Because that's another cost. If you rebalance too quickly or you trade too quickly, it makes things more expensive. And arguably, for example, you might have a tactical allocation, asset allocation. That's always a lovely thing, it's a psychological thing. So what we'll do, Robin, is we'll give you 60% bonds, and 60% equity and 40% bonds. So that's the most common thing. We'll do one of these risk tolerance questionnaires. Close your eyes, tick the boxes, and it'll come out 60-40. And then what we'll do then is, but we do is tactical asset allocation. So for example, if we notice that there's a president somewhere in some country that's going to have an impact on markets, we might take a pivot before then and predict what's going to happen. And you go, hold up a second, you're doing exactly the same. We tell clients not to time the markets. So that's just a behavioural thing that looks good in marketing. So we take it back 60%, 40%. Where does all the money go? So obviously that costs some money to do that. But then again, when you think about it, so a really big asset manager, big well-known name, might do it for 25 basis points. So 0.25% a year. They will deduct from the fund's value, plus some trading costs on top of that, what we call the MiFID II charges, which is people should keep an eye on. So let's say all in all, it costs on average each year 0.33% to run that fund. Now, if that fund does really well, and as Jack Bogle once said, in investing, you get what you don't pay for, why then do, for example, some asset managers, let's say, charge 0.8% or even 1% for the same 60-40 portfolio? Well, they would say it's because they've got an insight into the future that nobody else has got. They're doing better due diligence, wherever. But when it comes down to it, all it is to run their business, they're having to build in a margin on those funds. So, and therefore, and it might be they have a more expensive operating model. For example, they're operating in alternatives and things like that, so they've got bigger research fees. But ultimately, when it comes down to it, who's going to be better off? Is it the person paying 0.33 or the person paying 1? History tells us it's the person paying 3.3. But some people just aren't bothered about that, because what they're saying is, I really like the fact that even if I know I'm paying more, but I love all the updates I get from my advisor, and I love all that sort of stuff. And then it takes us to something slightly different, which is the DFM. Because where you've got a discretionary fund manager or a discretionary investment manager, given their proper name, they're able to then, if it's the right type of DFM structure, what we call bespoke, they're able to, within the realms of, what's good economic sense or a good investment sense, make choices for the client that fits their client, and clients are willing to do that. And it's a bit like, going to use a Tim Hartford thing, if you go into a coffee shop and you order a cappuccino, let's say it costs you £4.50. If you order a hot chocolate, it costs you £4.50. But if you have a macchiato, it will cost you £4.75. It's just a blend of the two, but you've expressed a preference. So that's...
We should just explain here about discretionary fund management, that there are all sorts of DFMs. Some are very active and actively managed and expensive, and some are evidence-based. Some are simply portfolios of index funds, for example. So there is a wide variety of DFMs on offer, isn't it?
Yeah, absolutely. So what it could be as simple as, so for example, let's say an advisor, let's say this is a real minority, an advisor runs their own portfolios. And what they might do is they use the asset allocation model from, with how much in bonds and all, how much in equities. They use from the platform, because a lot of the platforms build these in for advisors to use. And then they do some research and they pick some funds to fit those slots. Now, the thing is that let's say they made a mistake and they went to the wrong continuing professional development CPD event, Robin, where you get a memory stick, a pair of seems to be sunglasses at the moment. It's winter, I don't know why. They get that and they get some free coffee and some moleskin notepads, and they sit there through this presentation and they're absolutely convinced that this person's got a double first in mathematics and economics at Oxford University, and he can get 40% return year in, year out by trading hedge funds, let's say. Remember that conference? So they do that, and then it turns out not to be true. Surprise, surprise. So, and some of his clients have a proportion of their funds in there. So what he's got to do is go around to each client. Let's say I talked about earlier 100 families that most people have the capacity to look after, is to go around and go, right, what we're going to do is, I've made a bit of a bad choice here, Robin. What we need to do is to switch this fund from here to here. What you've now got to do is you've now got to get 100 people, essentially, to agree to move the funds. Now, the regulator's going to say, if they all time that trade at a different time, they're likely to, is on some people they might be on holiday, might be doing a world cruise, you can't get hold of them. So what happens is you've now got 100 different portfolios. So your central investment proposition, technical term, isn't robust. So this what's called advised portfolios is incredibly risky because you can end up with the drift, and over time clients have different portfolios, and therefore a client with the same expectation ends up with different returns than their next door neighbour with the same expectation, the same needs, So what happens is firms can say, right, what I'll do is I'll apply for a discretionary permission. Now, there's great rigour from the Financial Conduct Authority to make sure people do that. They have to put a lot of money on deposit and all that sort of stuff. Because what they can now do is now they can trade on their client's behalf. Right, that was a bit of a dodgy decision with this person, the CPD event. What I'm going to do now is pull the lever, and then I'm going to trade into another fund. And I'm actually going to do that day, and I'll send a letter to the clients telling them what we're doing. And that's what discretionary permissions enable you to do. So quite often firms do it just because it's easy. You can run your portfolios, and also you can make sure that everybody has the same portfolio, which is a good thing. But it's very different to a discretionary portfolio, because a discretionary portfolio traditionally is a stockbroking term. So you would have met somebody probably called Tarquin, who probably had a Labrador up the corner, who probably wore Barber when it was a British-owned brand, who would have sat there, who would have read the paper every day and gone, British Airways doesn't look very good at the moment. What we'll do is we'll move from British Airways into Ryanair. And he'd phone up the client, this is what we're going to do. Everything okay there, Robin? I'll get the paperwork done. That's it. And that's developed now into, they've now got huge resources. They've got, analysts and so they don't operate like that. But what they'll do is operate as well as any asset manager. But what they will say is, I'm going to operate a broadly, let's say a 60-40 portfolio, but the stuff we put in there is stuff that you really understand. And this has become really important now with ESG, or particularly clients who want to invest to positively support the economy to try and get us away from this mess, which is climate change. And they feel huge value from this. And it's really hard to do this from a retail fund, because we've all got a slightly different view. So we can sit down with a client and say, what does good ESG investing mean to you? What is good, if we want to invest, let's say, climate change, we want to be wearing the white hat and not the black hat and investing, what would it be? And the client says, well, I'm actually interested in whatever. Right, okay, let's do the due diligence and let's put those funds in. So it'll still be the same structure as in, let's say, 60-40, but it'll be stuff that the client knows, likes, understands, and the advice firm is happy to sign off.
Now, there is another charge that I don't think many clients understand properly, and that's the platform charge. Advisors talk about platforms all the time. Maybe you could explain what platforms are, what service they provide, and what you can expect to pay for them.
Okay, so what you've got, and this is an interesting point for anybody really, particularly if they're looking for advisor protection as well, because that's one of the main points of a platform. So first of all, your fund. So your fund has to be invested under the rules we adopted from Europe, has to be invested with a custodian. So your fund manager doesn't theoretically hold the assets. The assets are held by a non-profit holding custodian, and they pay for that. And that's built in within your charges. So your funds in with a custodian. So for example, if that fund manager went bust, all the assets sit with the custodian, and the custodian then distributes them to the client. That's the theory. And then what happens is a platform's a custodian as well. So I've got a fund with a well-known name, with a custodian, and I'm now with another custodian. So I'm paying for two custodians, which is quite good in a lot of ways, because I've now got two forms of protection if anything really goes, the wheels fall off the world economy. So you've got that. So that's pretty good. But the other thing that platforms came up with, not only just being a custodian, because that's where they started, they then said, well, actually, because of emerging technology at the time, people started to think computers, we can do what's called a fund supermarket. So very much like walking into, I mentioned Tesco's earlier, there are other supermarkets available. You can walk into Tesco's and you can not just buy, Camp coffee, is that a thing anymore? Anyway, but you've got a range of coffee. You've got a range of coffee you can buy. You can choose this thing in Nespresso or whatever. You can get that in the choice. So what it is that rather than just having a one fund, we can now say to a client, what we've got the universe of funds available to us. And what we can do is we can choose the universe of funds that are available. We'll do due diligence on top of that to make sure you've got the right range of funds that are appropriate. We've ticked all those boxes. I talked about the $1.5 million spending earlier. We can do all that, but what the platform enables us to do is to access them. And so what the platform does is the really efficient trading. They hold multiple share classes of funds as well. That's a key thing for people to look out for. So you could have the Robin Powell Birmingham Opportunities Fund. But what you could do, you might say, and you could be, let's say, C-class. The C-class is generally, don't ask me why, that's generally the normal retail, what we call retail class that advisors would offer to the clients. But there might be another class, an A class, and that might be an old legacy class that's more expensive. Exactly the same investments, exactly the same people looking after them, exactly the same coffee machine, everything else, everything's the same, but you just pay more for the same thing. And then there might be something, let's say, called an X class, and that might be you use that for other fund managers that want to buy that fund, and you do them a special deal, and you'll only give them access to that X class if you tell the platform you've given them permission to access it, and that costs a lot less. So what you've got is you can have the same fund with multiple charges on the platform, and platforms enable this huge choice. So what you've got custodian, you've got the fund supermarket, you've got all the different share classes. They actually pay the fees to the advisor. They have cash accounts in them as well for any money that's held in cash. Let's say it's got to be distributed to pay for income. So they do that. That's another subject to that one. And then what you've got is, you've got the tax wrappers. Because of course, one of the big mistakes we can make in life is having the inappropriate tax wrappers. So, we worry sometimes whether they've got the right fund, 0.33% or, 1%. Whereas of course, we could lose 60% on our investments if we choose the wrong tax wrapper. So all these tax wrappers there. So for an investment, the advisor has, sometimes called wraps. The advisor has choice. They have the tax wrappers. They have simplified admin. You can have 100 funds and your dog doesn't need a helmet when the postman comes every quarter, because all this remember people used to come around and post these things that weren't, adverts for retirement homes, which I seem to get. So they post all this stuff through every quarter. Don't get that anymore because it's all digital. And so you get one statement with everything you have listed on there, all the charges, all the income, everything else, what tax wrappers they're in. You get it digitally and it makes everything simple for both parties.
And how much can you expect to pay for a platform fee?
Well, it depends. So we talked about networks earlier. So what a network will do, Robin, because they have buying power on behalf of their advisors. So let's say you have a network of advisors, like I said, that piece of paper that says at the bottom, Robin Powell's a member of, which I know you're not, an appointed representative of, it would be like that. You go, right, so we're dealing with Robin's appointed representative of, and what the network will do, they'll go and say, right, we're only going to have, let's say, two platforms, for whatever reason. We're going to have two platforms. Who's going to give us the best price? So they'll look at the features, they'll look at the security, they'll look at all that sort of stuff, anti-money laundering, and they'll do all that sort of stuff on the due diligence. But and when it comes down to it, the beauty parade is who's going to charge us less. And it might be you're being charged 0.15% on your assets. So you've got your fund charge, you've got your 0.15. Some other platforms might say, we don't play that game. we provide an outstanding service. Outstanding service. You get to speak to the same people all the time who are using the same MacBook Pro. They're doing all, everything's robust here. We use the best of everything, and we charge 0.4. Now, that's an extreme one. We charge 0.4, but you're getting value for money because we just don't make mistakes. So, and it's that the majority are somewhere between 0.15 and 0.25 of the money you have invested on the platform.
Platforms also hold cash, don't they? And this is, again, a bit of a murky area.
Yeah, I mean, when interest rates were low, and this is the interesting, the whole fascinating thing I find about the advice industry and profession at the moment, Robin. So you mentioned earlier about ad valorem fees. So from 2013 until Liz Truss, it all worked. It all worked because we had low interest rates, investments were performing relatively well over and above inflation and things like that. Everything was honky-dory, was working. Now, when things went awry, it wasn't just Liz Truss, of course. We'll call that pandemonium. Then we had Putin, and then we had the pandemic. When things just went a little bit ski-whiff, and obviously we're still living with that, pulling through it at the moment. Now, what happened with the increase in interest rates? Straight away, your platform was paying you nothing in interest. And you were happy with that because your local high street bank was largely paying you nothing as well. And then all of a sudden, you could get commercially through, there's people like, I'm going to mention a name, Flagstone or Insignia. So the big two players in what they do is they get commercial rates of, obviously only get advice on this, commercial rates of cash. Direct from the banks. And so, for example, they could offer, let's say, 40 different banks interest rates and negotiate. So let's say you got more than £50,000 on deposits, you could get, at one point, you could get 6.75% gross, which is ridiculous compared to where we're at. Now, what happened was, now some of the self-invested personal pension plans, which is another way of investing your money other than a platform, for retirement, they have those services plugged in. So your cash for paying your charges, and your cash for part of your portfolio, and your cash for paying out your income, sometimes it can be more than you've got, it can be quite substantial. Now you could then plug in and hold your cash there, and you get a really decent rate of interest. Now on the platforms, and a lot of the platforms are owned by big banks as well, a lot of the platforms have been caught out and paying on the interest rates, and some of them do pay good interest rates, by the way, but some of them are still operating pre the pandemic, the pandemonium, and Putin. And so as a result, people have started questioning now, well, okay, where's the value for money in this? And the regulators started looking at it. But what they would say is, we're not a bank, it's just a facility. We're not a bank. It's not. It's called a cash account, but you shouldn't really get a lot of money. That's not our business model. But there's no doubt people are saying, hold on a second, how much interest are you really getting on this? And so you might be saying you're charging 0.15 to, let's say, 0.25, but you're probably making a margin on the cash. So a lot of advisors, obviously the best advisors, which is the vast majority, are now questioning the platform choice they have, and it's quite easy to migrate from one platform to another. And then this cash thing is now raising its head, where what people have either got to do is start paying a really decent rate of interest for cash, or the advisor will move to a new platform, move their clients to a new platform that's paying a decent rate of interest for cash. And I think that's something that's in progress at the moment.
So you've explained that there are a number of different charging models for financial advice. You've explained different fees, investment management fees, platform fees, and so on that people pay to invest through a financial advisor. I suppose the key takeaway from this is for people to understand exactly what those fees and charges are going to be before they agree to work with a financial advisor.
Yeah, absolutely. And it's like with anything, it's an interesting non-parallel, almost as a parallel, is what's going on in car finance at the moment. Because people took out PCP style agreements on cars, not understanding how the dealership got paid. And as a result, now we're in this thing now, Supreme Court, and hopefully good outcomes will come for people. We are far more transparent in financial services, far more transparent when you think about everything we have to do to make sure, as somebody said to me, proved it. To take out an ISA in the UK, you will get, whether digital or hard copy, 32 pieces of paper to read through, just to take out an ISA. Now, in there are all the fees disclosed to the penny, except for their fees for running the investment portfolio. I think what people have got to do is challenge in a positive way with their advisor. Just get to understand what's being charged, how it's being charged, why it's being charged, and how will they benefit from it. They certainly will benefit, but that puts them in a powerful position. And like anything, just don't accept the first advisor. See 3 advisors, let's say. Use one of the good, find a good advisor sources, and I know that you do yourself through the Evidence-Based Investor. And then what you can do is interview a couple of advisors and then decide who's going to give you the best service and the best value for money for what they're going to charge. I think that's really important.
So what would you say are the key questions that people need to ask a prospective financial advisor regarding fees and charges?
First question is not a question, which is, sorry, just to be awkward. First of all, I always say choose a financial advisor who's younger than you, because that's really important as you get older. Because what you don't want is you don't want a financial advisor who has a capacity for making financial decisions because of their age or circumstances that's worse than your own. It's a bit of an ageist thing, but it's an important thing. And also you want to make sure that when you do fall off your perch, that those that are left behind have the optimum advisor. And I think that's a key thing. The other thing you need to ask them about the qualifications. I believe, for example, if we were going to build a bridge, would you have a diplomaed engineer or would you have a chartered engineer? I know what I'd have. So with your advisors, I'd ask for the qualifications. I'd at least want my advisor to be chartered, at least, and I want to know what extra qualifications they've taken on top of that as well. And another question is, what continual professional development do they engage with? How do they obtain it? And how do they make sure it's independent and not biased? I think that's really important. It's okay going somewhere and getting a rubber stamp. If it's run by a fund manager, a CPD event, and you get your memory stick, your cup of coffee and whatever, if you do that, in medical science, for example, that they've learned from this. It should be done by academics or people who are subject experts and not by somebody who's trying to flog a fund. I think that's important. Should ask about that. Then when it comes to charging, I think just because we know, great advisors have great personalities. It's a personality game. They want you to know I can trust them. That's how we do anything in life. With everything we engage with in this, capitalist economy that we live in is done on know I can trust. That's how we operate. So that's important. That's important you do that with the advisor. But don't let that blind you to the charges. So I would go through the charges piece by piece, quizzing the advisor about how will these value me, and how will they add value to my family, and what could I get elsewhere for the same? I'd just give them that challenge. I'd always give them that challenge. And an important thing, like with any negotiating thing, always take it down to a beauty parade of the last 2 and squeeze them a little bit. Now, somebody might not be willing to come down on charges because they believe their service to be amazing and what they do is amazing, which is great. If they are that's fine. That's not a bad thing, is it, in that way? But you just got to make sure. The other thing I'd just say as well, which is about what you're paying for, some models are what you do is you go quarterly digital newsletter, you go once a year meeting with the advisor, and the advisor can phone you. You can phone the advisor when you'd like to bounce things off them. I think as you get older, I don't think that works. You need a servicing model that you're paying for with ongoing fees that works for you. So that's why I believe that what you should do each year is review your advisor and not let your advisor just review the portfolio and how it's performing, how it fits in the financial plan. It's what have you done for that fee over the last year and how have you added value and what are you going to do this year? Because they certainly shouldn't be sending you, voice faces of Apple News. You can find out far more information than a quarterly blinking newsletter, especially if it's being sent digitally. And you need to be speaking to your advisor more often and you need to be updating things more often. And quite often things happen in life when we make a financial decision, we should be speaking to our advisor. So I think your advisor there, particularly if they're using things like Teams,
But I'd question them around that. I'd really question them to make sure that you go, yeah, this is right for us. This is right for us. It might be costing X, but this makes me feel happy and gives me that peace of mind that everything's going to be run properly. So I'd ask them that. The last thing, I would ask them about their due diligence process. Really ask them about how do they carry out due diligence, and how is the insurance provided that underwrites that due diligence. That, because part of your fee, like I said earlier, is for time, expertise and insurance. Just make sure that they will have a really good insurance provision behind there, but how is that insurance doing it? Because, for example, if an advisor makes a poor decision and they have a personal liability of £2,500, which is often the case, and they've got 100 families, it could quite quickly put them out of business. So I'd just make sure they've got the right stuff in place.
We've seen a growth in the last couple of years in the number of financial coaches. It's also called non-regulated financial planning. It's becoming more popular. What's your own view of that?
I think anything's good if it reaches more people. Anything's good. Quite often for that model to work, what you've got to do it on a group basis. For example, through employer schemes. And I think that's really important. So, for example, if you've got a large employer who's got old phrase, workplace pension, group personal pension, what you would do is, what they can do is bring them together and they can do financial literacy, financial education with them, and then sometimes they can speak one-to-one. I think, we've seen examples of this. I personally spoke to somebody who's got it and said, absolutely fantastic, because not only did they talk to them about their pension, but they actually spoke to them about their mortgage, and they told them that they could, just by shopping around, they could make things far more manageable than what they were currently by porting the mortgage somewhere else. So, and they said it was invaluable. And I think that sort of thing is absolutely fantastic. It's great, it's really important, it's scalable, because we can afford to give advice to people, and quite often the employers will pay for this service as well. So I think that's really, really great. I think where it starts getting murky is where it's on a one-to-one basis, and you're giving financial planning, financial coaching, you're doing for example, let's say timeline, cash flow modeling system, great piece of software, or Voyant or whatever, others are available out there. You do that, then it gets to the point that we could all go, but where should I invest my money? And that's where it gets tricky, because based on that then, you are almost implementing, and therefore, arguably, you should have liability insurance in place. And I think this is, I would get really good legal advice. If I was an advisor doing it, I'd get really, really good legal advice on it to make sure I'm doing it properly, and make the client absolutely aware about where I stop and where I start. However, saying that, and putting that to one side, let's say it was all hunky-dory, I think it's fab for those, if the focus is on getting people to make the right financial decisions going forward, with the right outcomes, and be able to build the story and bring meaning and purpose out of their life, and all that sort of stuff. I think that's fantastic, because when it comes down to it, a tax wrapper is a tax wrapper and a fund's a fund, as long as it's constructed correctly. And whether it's got one label on it or another, you could argue, well, they're largely the same, because as long as you pay less, you'll get more, da-da-da-da-da. I think that's fine, but does it give full peace of mind? And I think we've just got to be really careful how we do that. Particularly the client is going to have access to the platform, and that means the client can do irrational things. So I just think we've got to be careful. We've got to think it through far more.
Final question. You said earlier that you yourself use a fixed fee financial planner. What value would you say you've got out of your planner?
Oh, fabulous. So I've got my own idea on where my money should be invested, and so we have a bit of a debate. We had a particular debate over gold, which I'd just like to say, just in case he's watching this, I was 100% right, but I'll take it on the chin. but no increase in fees. But I think it's the one time I was right, Robbie. But what's really good is do you know what? You can just pick up the phone, or you'll get a phone call now and again, and it just says, how are things going? And you'll say, yeah, they're going pretty well. Being as you're here, I just had this great idea. And what's that great idea? I've thought about buying X. And they all go, right, okay, would you like me to run it through the software? And you go, that'd be brilliant. Shall we do a screen share? So we do a screen share, it's magic now. And then you can go through the screen share and you can go, actually, it's not really a good idea to do it at this moment, is it? No, it might be better to do it this way. And you go, that's absolutely brilliant. But it's also been things like my wife, for example, so My wife Jo, what she wants to know is she gets on with the advisor and she wants to know if, let's say, our pop McClogs, earlier than expected, that she's got something she can phone and she can take away. We talk about dying tidy, dying tidy is leaving everything in place. Look, we know what it's like when people are incredibly vulnerable, on death. They want to be able to speak to somebody they know, like, and trust, who is then capable and able to put things in place and knows what the family situation is. And I think that is really important. So it's things like wills, powers of attorney. It's a bit like having a safety deposit box, believe it or not. That I think in California members are probably very valuable. But it's about having a safety deposit box with everything's in. I believe in the key. One key that unlocks everything, and everything's there. You get access to. So you've got that. You've got a person you can bounce from. You've got the peace of mind, and also you've got every time there's a tax change, which we seem to get quite a lot. It's just making sure we're using the right tax wrappers. That's been pertinent at the moment. Capital gains tax, unwrapped investments at the moment makes absolutely no sense whatsoever to hold unwrapped investments. They might as well be wrapped in something, which is far more appropriate, and then you save yourself a stack of tax. Totally illegal. It's not tax. It's not tax avoidance. It's one of the things we can use, but people choose not to use it, and then they're going to pay a load of capital gains tax. Well, it's only with an advisor you can get made aware of that, and I think that's the huge value to me.
David Owen, you've explained these issues very well. I'm sure our viewers and listeners will find your insights really helpful. Thank you very much.
Thank you.
That was my interview with David Owen. Thank you to David and to our sponsor, Timeline. Timeline provides best-in-class planning technology and portfolio management solutions that enable advice firms to deliver exceptional value to their clients. If you enjoyed this interview, why not subscribe? And please leave us a rating. We are always grateful for your feedback. Until next time, goodbye.